roundtable call. Today's call is entitled Compensation Structures and Their Implications for Alternative Asset Managers. I'm Tim Fritter of TriNet, and the call's moderator. Very pleased that we have Greg Kastner, Senior Tax Manager, Financial Services for Baker Tilly. He really is a veteran with a broad perspective of compensation structures for alternative asset managers. So we're going to go through a Q&A session with Greg, but before we get to that, we're going to go over some compensation benchmarking and data that TriNet has accumulated over its private equity and hedge fund client base. But before we get started, and again, thank you all for being here this morning on this rather cold Monday. And hopefully everyone had a great short week. But before we get started, I just wanted to thank the sponsors of the New York Alternative Investment Roundtable, which makes events like this possible. Alston Bird, LLP, Bloomberg, Baker Tilly, Grant Thornton, New Capital, Forensic Systems, and Kaya. So again, thank you very much for everyone joining. I'm Tim, and we have those that are dialed in to be able to see the PowerPoint. We're going to go through slides of a study that TriNet recently did through a study of all of its private and hedge fund clients. We're a payroll provider in that space, and so this is real data and very, very accurate and pretty recent. So we'll get started and then get into any questions. And as we get moving, obviously, if there's any questions specifically that you want us to address during this presentation, please raise your hand on this WebEx. Otherwise, we'll certainly get to your questions. Introductions, Greg, and I'm Tim. Thanks for being here. So quick, TriNet did a study. It was all for full 2016. It's based on proprietary payroll data from TriNet's alternative investment clients. The alternative investment companies, including hedge fund, private equity, and venture capital for the full year 2016, represents 1,400 firms and 14,000 employees. State, most of it obviously is in the tri-state area, but also you can see California and the rest of the United States, just in terms of the clientele that we surveyed. By size, you see just in terms of the number of employees on the left and AUM on the right. This should be job function. Just is the breakdown of the percentage of number of people that are in each of these firms. TriNet client base is typically an alternative investment manager with anywhere from 5 employees all the way up to 200 employees, from a variety of alternative with a variety of with AUMs. Job composition by company size. Again, your smaller company, there's a higher percentage of executives where they're wearing a lot of hats. As the company gets bigger, the executive staff shrinks, and there's more finance professionals. But you see the makeup in company size. Company size and region. So this is just by company size, less than all the way up to 51 plus, average compensation, and then region as well, California, tri-state, and rest of the U.S. from a salary and bonus perspective. By job function. This is specific to the TriNet, to the tri-state region. Job executives earning the majority share of the compensation here. Financial professionals next. Marketing, IR, sales, client services. Obviously, risk and compliance and IT are heavily in demand employees, and so they tend to make a little bit more as well. Breakdown of from your chief executive officer all the way down to a partner or principal gives an idea of pay ranges for each. Financial professionals, anything from an analyst all the way to a vice president or a trader, to get you an idea of compensation ranges for each. Marketing, IR, sales, and client services, same thing, salary, bonus, plus commission. HR accounting, anything from an accountant to a vice president to a director of human resources. and compliance, attorneys, risk, high and demand positions, and certainly getting a good for the compensation. Engineering, software engineer, data analyst, director, assistant engineer, administrative staff, office manager, and so on. So that's real quickly just some numbers, and just really want to lay the groundwork for the questions with Greg. So we can put down dollar amounts on a piece of paper and put this on screen to share with you, but really it's about the compensation and the structures and what gets into them. So next, just get into a quick Q&A with Greg and go through some questions to kind of think about as we talk about compensation structures that ties together what we just showed with some of the data. So to just kind of get started, right? Greg, hedge and private equity funds generally, do they have two different streams of revenue with which they can pay their employees, or what does it look like?
Yeah, and for having me, Tim, by the way. Yeah, generally funds have two streams of revenue, right? They have the management fee, which is generally based on a percentage of assets under management under the old typical 2%. And then also they usually get a carry or an incentive or the profit allocation, and that's, in the typical was 20%, but obviously everything can change depending on the fund. So with regard to the management fee, that income is generally, since it's fixed on assets under management, it's going to be subject to self-employment tax. It's going to be subject to unrelated business taxable income. If any of it were to flow to, let's say, tax-exempt investor, it's going to be subject to the unincorporated business tax if you are in New York City. So it's taxed at the highest rate. So what most companies do is they pay their expenses out of this stream of income. Pay their rent, their utilities, their payroll, software, research, et cetera, fixed assets. So if you end up paying someone just compensation, just a W-2, that would come out of this management fee revenue. The second stream of income is the cut up the profits, which is also called the incentive reallocation or carve-out. And these, not only can they charge a fixed percentage, let's say 20%, they can also, it can be, it can have a hurdle rate where it has to, let's say, beat whatever LIBOR or some other fixed percentage that's kind of arbitrary, can be decided on. And you can also have something called high water marks, where it says basically if somebody lost money last year, you have to make up their money, back it up to zero before you can start to charge incentive on the current year profit. So the distinct advantages of having this incentive reallocation being allocated to a partner as opposed to getting a cut of the management fee. If it's going to partner, you get to retain the long-term capital gains and the qualifying dividends and not pay tax on the unrealized gains. One side would be is if the fund is not turning the portfolio over as much, this fund might have their expenses of the fund, let's say the accounting fees, the attorney's fees, those might be considered portfolio subject to the 2% of adjusted income floor, and therefore, when those pass on to the they might be an AMT, or even under the new proposal, there might not, they lose those altogether, under the new tax reform going through Congress right now, because, hey, one of the things they're doing is going to be limiting itemized deductions. And also with the management fee, the income is generally sourced to whatever state, various states, where the incentives generally, unless it's like loan origination fees, oil and gas royalties, or real estate, that's not, it's going to be sourced to whatever state the partner ultimately resides in, because most states have this trading for your own account exception. So those are the two streams that generally that can be paid to the that can use to be paid out to the employees.
So with multiple revenue streams, that's that this can be paid out, but just in terms of you have superstars, you have those people that are really they may be a good salary, a high earner, but they're really your top performer. They are your superstar. Are there to pay them as well, or is that just kind of is it just and salary?
Yeah. So there are two ways. So they can receive a W-2. That's the standard rate, and then you have the withholding done, and just like I said, you generally pay that out of the management company. But also receive a partnership interest. And the partnership interest has some consequences. Actually, one of the things I wanted to mention also on a W-2 or paying through, let's say instead of paying through a W-2, they can also get paid as if they are a partner through the management company, getting paid a guaranteed payment. One of the things that people have to keep in mind is if they're paid a partner and getting paid through a guaranteed payment, for the deduction to happen, the timing has to be the same. So the partner would have to pick up the income in the same year. Whereas if you're paying through a W-2, the company and the companies on an accrual basis at the county, they could accrue, let's say, $1 million bonus, and then they'd have 75 days after year end to pay that. So that's one advantage of paying through a W-2 if you wanted extra 75-day float with regard to that. However, if you're paying instead of paying out of as a partner, you pay them as a profits interest, because when you receive a profits interest, they partners get you. It's only a non-taxable event, whereas a capital interest is a taxable event. And the difference between a profits interest and a capital interest is that a profits interest is a cut of future profits, whereas a capital interest, if you liquidated the company, that meant on the person would receive some sort of cut of the liquidation proceeds, and if they would receive some sort of cut of the liquidation proceeds, that would be a capital interest, and would be taxable as whatever it's as compensation to that employee. And if you do the profits interest, hey, you're getting them a future cut, and if the company's up in value, and you make money during the year, he pays tax. Then, and so you can also, let's say you have it's private equity, and the first couple of years before the carry has been cut in, you didn't give this particular guy a cut, but you can do some sort of catch-up provision as well to get up to a certain percentage, especially if the profits haven't actually started being paid out yet. Generally, when you receive a profit interest in a partnership, you want to also make something called an 83B election, because when that, you're basically saying whatever going forward is in value would be, you could probably get capital gain treatment. So if IRS were ever to come in and reclassify that profits interest, maybe some sort of value as a capital interest, then at least you'd get capital gain treatment going forward on that. And whatever you end up doing, you want to make sure that all parties are kind of on the same page as to how it's going to be treated, but what the impact is. Because obviously, if you have a fight 3 or 4 years down the road, especially if somebody's leaving, litigation costs can be crazy expensive. So you want to just be sure that everyone is kind of on the same page on what you're giving and what you're giving up.
So today, each company's situation, each fund is very different and unique, and everyone's obvious tax situations are different and unique, but you have to keep everyone on the same page within the firm and just, have that discussion, up front when you're long in having that discussion, or, as you are growing, if you're bringing on new partners and you're kind of growing up beyond your, 3 people that started a fund, that's something that really you have to be on the same page with.
Yeah, absolutely, Tim, absolutely. You know, as you were showing the statistics of different funds, I mean, every fund is different because obviously every fund is going to have a wide range of assets under management and how liquid the assets are to pay employees. I mean, you couldn't, a private equity fund, there might not be cash right up front to pay somebody. It might be a couple of years down the road, whereas you might have a little bit more flexibility in terms of paying somebody up front. So we've got to tailor the compensation structure to whatever the whatever funds the economics look like.
So, so with that said, tell us about the existing partners and what issues, besides, figuring out how am I going to structure this, down the road when we start hiring people, what are the types of issues that they should be aware of, current state as they're operating?
Yeah, definitely. So one of the things you got to keep in mind is that when you are in a partnership interest to now an employee, you're going to suddenly give them access to the tax return overall. And even if they wouldn't necessarily be able to see all the K-1s, they can mail in, I think, $50 or $60 to the IRS and look at all the tax returns. So if you're getting a cut of, let's say, some one side pocket or a certain tranche, you may want to be sure you want to give them access to that, and you may want to pay them through some other entity or not make them a partner. Also, if you're making an employee now suddenly a partner, they can basically speak on behalf of the partnership. So you want to know that they're meeting all their ethical and standards and sort of thing. And from the also, let's say the guy is maybe not in the state that everyone else is in the state. All your partners are located, or let's say they're in the United States, there might be some withholding, or hey, now you have to actually file in new states because you're giving a cut of that revenue. It's generated in another state. So the existing partners might all of a sudden have to file in extra states as well. And one thing to keep in mind is, hey, if any of the funds, it's really easy to give out, 5% here, 5% there, because the cash flow to pay somebody through a paid W-2 or a bonus. But later on down the road, if intent is to sell the entity off, it's probably cheaper in the long run and more beneficial to the founders to not be giving out those percentages. And one thing I think I'd like to keep in mind also is that, for the employee, all of a sudden, if he becomes partner, he's going to have to file estimated taxes. He might be filing a bunch of new states that he hadn't filed in before. He's going to be in charge of making his own taxes. He's going to have to wait for a Schedule K-1. He's not going to get in a W-2. The rules from medical insurance, retirement contributions are going to change. He might end up having to file in multiple jurisdictions, and all of a sudden now he's going to be liable possibly for at least for his investment in the partnership, if it's a one partnership or if it's a general partnership, which obviously most of these companies are not set up though, but he would be liable for that. But all of a sudden if you're requiring him to put $100,000 in to have skin in the game, that's going to be risk. So he's got to think about it. Also, so those are some of the things that he has to keep in mind when he becomes a partner. And the other thing is there's new partnership audit rules that are going to come into starting on January 1st. And those audit rules is basically saying that partnership doesn't opt out of the rules, and small partnerships can. So in a lot of cases, these management companies and these vehicles can opt out of the rules as long as everyone's an individual. But if they don't opt out of the rules, and let's say you're admitted later on, you must, and the partners don't want to do it, if some sort of tax liability for something that happened 2 years ago, some mistake was being made, and the partners that are in the partnership now, they pay for it. So let's say you're a partner, you come in, and there was some mistake made 2 years ago, and they don't opt out of these rules, then you're a new partner, you might be on the hook for your cut of that in today, and not get that offsetting loss maybe until you leave the partnership.
Interesting. So, really, as you're going into a partnership and bringing those in, you really have to, again, everyone has to be on the same page. And, if you are venturing and going into that situation, with the current firm, maybe that's a little bit of a larger firm, really just, explore and understand the whole scenario, work with your own, tax counsel, and to go through and this. So, with that said, if we're talking about structures, would a Chapter S corporation be beneficial in this way, or in what way?
So, and this might change because one of the things that's happening with the tax reform proposal on the page is that S corporations' profits are now not going to be excluded from self-employment tax. But in the past, what we've used S corporations, they pay, maybe they max out the Social Security and just pay, and pay up to like $127,000 maybe in 2017, and the remainder of the profit is not being subject to self-employment tax. So that's one of the things that people have been doing, is to use this S corporation to avoid the self-employment tax on a lot of the profit, but also, the S corporation would not be subject to these new partnership audit rules. So one of the bad things, though, is that S corporations can't have non-resident aliens, can't have partnerships, can't have corporations as partners, and and everything gets allocated up based on shares. So there's no way to do side pockets, no way to do tranches, no way to do benchmarks, whereas you have complete flexibility with a limited partnership or a limited liability company.
Okay. So, is very important, obviously. So, something that, I think we see different firms kind of do differently is really how they kind of look at bonuses and structure them. And, some funds do it to individual performance versus the fund's overall performance. So, what's your take on that? Should a bonus be tied to individual versus the fund's performance overall?
Good question, because, you motivate company stability, ensure investor loyalty, and one of the things to do that, ways to do that, is to align the interests of the employees with your customers, basically. So you probably want to tie, whatever someone's compensation is to the overall health of the fund. And to keep in mind what form it ends up taking is that every bonus you're paying has to adhere to the rules and regulations imposed by the Investment Advisor Act of 1940, the Commodity Exchange Act, the Dodd-Frank Wall Street Reform, and Consumer Protection. And there's a lot of data protection laws as well that have to be thought of. But, thing that, by tying it to the performance, you have to say, is it just going to be let's say it's a trader, his individual performance or his team's performance? Because if it's one individual's performance, you might cause some sort of rivalry with other traders, because everybody has limited resources, whether it's fund staff or researchers or where marketers. And then also, if traders aren't exchanging ideas, they might actually against each other and cause some sort of adverse tax consequences, or they might level up on the same position that maybe the manager would catch a couple days later, but in the meantime, you're hurting your diversity of your portfolio. And obviously, if you tie one trader, let's say, to the fund overall, be incentivized, hey, you might take big risks because maybe there's a bigger bonus for him. Whereas if you tie the whole thing, tie to everyone overall, you might feel bogged down because they go, hey, the people in this department really okay, and it might cause some high performers to want to leave just because, hey, I think I'm carrying these guys. You can achieve a middle ground by doing maybe some sort of approach, whereas if this team gets a profit, or you can do the same thing with compensation that you can do with the incentive, whereas you have a hurdle rate where you have to clear certain percentages before anything kicks in, or you can have a high watermark where you get back the loss that you had made in the prior years before you can get compensated. However, there's a couple of cons that come up when you do that. In that, let's say you have some sort of hurdle and it's actually negative, so you actually beat the hurdle but no income. So what do? Do you compensate the guy the next year? Do you have an accrued, or do you take, if that's based on like the incentive stream, maybe do you go against the management company stream? And so those are kind of, and what happens if the guy leaves after a year? Does he not get it, or does he, if he be disabled, or passes away? What's the then? These are some of the concepts that have discussed and should be in agreements beforehand, hopefully alleviate any problems later on. And another thing to keep in mind is that if you're tying compensation to performance, right? Are you to be, let's say the fund overall wants to look at things 3 years down the road or 4 years down the road, it ties compensation to some short-term performance. You might be encouraging them to maybe in some things that aren't what the stands for. Or the flip side, they're trying to use the foot on that too.
Again, it depends on each company, and a situation is a little different. So, in general, bonuses, they can be paid through vesting, either pre or post-tax. Is that correct?
That's right. So what you can do is, if you do it based on pre-tax, it's especially through the management company, that it's very easy because, what happens if they end up leaving or they don't vest, and no one, the company has, the investor hasn't paid, the employee hasn't paid any tax on it, so you just don't give it to them. If it's post-tax, it gets a little bit more complicated because the partners don't get a deduction for it. So let's say the bonus is $100. Our tax rate is $40. They're going to have to come up with not only $100, and they're not going to get deduction for that $100, but they're also going to have to pay tax on that, on the deduction that they currently. And also, if you tie it where it's going to appreciate each year, let's say you put in $100, they don't get it yet because it's going to last a couple of years down the road. But they make $10 that first year. Again, the existing partners are going to have to pay the tax on that. So one way to alleviate that is, and obviously the guys will get a deduction down the road, but when they end up paying it. But one thing that a lot of people do is they say, hey, instead of them getting the $10 of appreciation, you do it net of the tax rate. So let's say that they get maybe $6 for their appreciation in that way. In terms of, and what a lot of people do is they want to leave maybe employees leave money in the fund to, again, encourage for it to go back up. And one thing to keep in mind is that there are certain rules that if you have a hedge fund or a private equity fund, you want to make sure that you don't run afoul of the accredited investor or qualified purchaser exception thresholds offered by the Securities Act 1933 and Investment Company Act of 1940. But there was something new in 2014 that said you're a knowledgeable employee. You can be a problem with that. But one thing funds do is they sometimes, for the deferred income, they set up a separate entity and put the income in that entity so that if there is a dispute down the road, investors don't see it. And that's one way to achieve that.
So other types of vesting as well?
Yeah, there's generally 2 types of investing. There's what's called cliff vesting, which basically says, hey, in 5 years, you get that income. And then graded or serial vesting, which basically says you get, if it's 5 years, you'd say, you get 20% a year for 5 years, so 20% is that's the first year, 40%, 60, 80, etc. And most, from what I've seen in my career, is most people do up to 5 years. It depends, but usually it's 5 years, up to 5 years. And whatever ends up happening, whichever you use, you should definitely address in the agreement the effect of death, disability, or termination without cause. Because again, we're talking about if there's a suicide order that unfortunately that comes to pass later on the road, you don't want to spend your life in work. And only what they do is when we do this vesting, it's typically the employee must be in good standing. So this way to retain high performance is through this vesting.
So, in retaining those high performers through this vesting, it's going well. You have the great people there. But what about those that are, leaving or retiring? What incentives are you used to motivate those people or partners to leave on terms?
Yeah, despite most employment arrangements today, being at will, what a lot of the funds are doing is offering, or the entities are offering severance packages, and in exchange for those people leave, just like sign covenants not to compete, to solicit investors or the employees, not to disparage the funds, and not to disclose maybe any confidential proprietary or trade secrets. And in terms of, let's say, somebody's retiring, sometimes what's used is something called a sunset distribution, and it's only available to somebody who's been with the firm for a certain amount of time. So instead of buying out a partner or who's in standing, which results in no deduction for the remaining partners, instead it would just add to their basis. The retiring partner could instead get a interest in the net management fees or carry over a number of years, and his share or her share of the ultimate sales proceeds would slowly decline until they're basically just gone. And you can, same thing with sunset distributions as you can do with any other sort of partner in terms of tying it to, hey, they don't meant to not compete, not to solicit employees or investors, etc.
Will you even see that on the TriNet side where they're doing the compensation and then they're still going to, maintain benefits for that person, for down the road for maybe another 5 years or what have you. So that's interesting how that connects. So, but just with when we're talking about motivating employees and people that are in good terms, there's something called the faithless servant doctrine that comes into play, though. Is that correct?
Yeah, that's right. So one thing that you can do is, when we were saying vesting, right? If it does vest, you basically claw back the money. So one thing that you could do is, if the employee has real or substantial misconduct that violates his or her contract of service, or he or she has engaged in misconduct that constitutes a breach of the duty of loyalty or good faith. If a state has this faithless servants doctrine, sorry, I can't say that, the employer can cover compensation that maybe has already been paid. But there's a number of factors involved in this, and that not all states follow this faithless servant doctrine. Connecticut, Florida, and Rhode Island are some that have rejected. The states that have rejected the doctrine. And also what comes into play is, hey, you've also got this choice of law issue. Choice of law meaning, let's say the partnership is organized under the rules of Delaware, but you got business in New York City and you have a trader working out of Connecticut. Which rule presides? So you've got to, when you're drawing up those contracts and the clause provisions, you definitely want to address those questions.
That was going to be one of my questions. And, if the company's headquartered in New York, but you have someone trading out of Connecticut, and some developing business in Florida, how does that all look? So, but you mentioned clawback. So I know we've heard that term before. How does it actually work?
So for clawbacks, it's basically saying, hey, you have this vet, right, where it might be over a number of years before you actually have the right to this income. So clawback is basically saying, hey, you don't get that income. It goes back to the company. So, for instance of like the management company, if you have these pre-tax clawbacks, you're getting cut of the management company and they're not actually getting anything until 3 or 4 years down the road. Well, the partners that are in the fund right now, the entity, right, are paying the tax on it. So if you take it away from the guy because it never vested, nothing happens. So it's very easy. That's super simple. With to the let's say instead it's post-tax, and the investor is the potential partner is basically going to be getting a K1. So how it works when you get a profits interest is either best 3 years down the road, you want to make the argument that you are in fact a partner. You should be starting to pick up that income on day one and getting a K1 from that amount. So if you got $100,000 of income in the first year of the management company or the second year of the management company, whenever, and you not invest till the second year, and let's say you leave before then because you get another job or you get terminated, something like that, or whatever reason. So it doesn't vest. So all of a sudden you've got a capital account that's $100,000 and you don't have, and what do you do? So generally what happens is there were some proposed regulations that were put by the IRS that did some sort of forfeiture allocations, but those have been withdrawn. So what it looks like is the partner that really has to forfeit the income, he gets like a capital loss, and then partners that leave, that get the income, they get the ordinary income. And then you have to, when you've got a profits interest in the vehicle, that becomes more complicated because, hey, what do you do if it's rated? Hey, we get 1% this year, 2% next year, 3%. That's pretty easy if it's a hedge fund, right? Or even private equity. Let's say maybe there's no carry being accrued at this point, so for them to leave, it's not a problem. But let's say in a hedge fund where maybe they're earning every year, it's pretty, you don't get that extra 2%, and they just have a capital account. Now, what happens instead if it's split and you accrued and you picked up like ordinary income, you picked up your share of dividends, capital gains, etc. If they're continuing, you might be able to do some sort of pure allocations, give them losses in the future, try to zero them out if they had some sort of investment. Now, if you don't have any investment, you run into the same issue where you can't do these forfeiture allocations, and then you've got this mismatch of, you might have ordinary income and then you have this capital loss. And, some people are saying that, under the 83B election, usually that's done for people in a corporation where they're getting some sort of compensation, and then they make this 83B election because if stock options go up in value, you get after that value you get capital gain treatment. But go down in value, you don't take the you get zero deduction. So if you apply the same sort of zero deduction theory to partnerships, it's kind of terrible results because the guys who don't vest, they get no loss from that. Now, obviously, a more conservative approach, and it's not really, the IRS has not written anything differently that you should treat it this way. It's kind of, they're leaving it open at this point. So it's determined to do in that case, but I think what a lot of people are doing is taking the capital loss.
So, a lot of different ways that people can kind of approach, because there's different types of clawbacks, different types of incentives being used, different types of vesting. I know we've seen it with some of our clients, but do some funds use options instead as a motivational bonus? And if they do, how does that work?
So what happens is options on a capital interest would be like a stock option, but they're not going to qualify for capital gain treatment. And one thing to remind is private equity companies that operate as LLCs with membership interest can't sponsor employee stock ownership plans and stock options, or provide restricted stock corporations, or distribute to employees actual shares or rights to shares. So, and an option on a profits interest, they have no increase in value prior to exercise because it's on future profits. So what most people do is they just try a profits interest because then they get a cut of the current, and then that takes away from the other partners and you pay tax on that income.
So that's an additional motivation tool and another alternative.
Yeah.
What types of perks can be offered? In the TriNet space, we'll see where partners are their benefits structured differently, where they have 100% coverage of a higher quality benefit plan, where kind of like the regular W-2 employees are getting 80% of that paid for, whatever. So there's perks like that we see. But how about from a management point? What other types of perks can be offered?
Yeah, I think I think we see like medical insurance. Maybe they give life insurance for the family. Maybe they're giving them a big expense account. The typical you get the company car. There might be some sort of matching with in retirement plans. And there's all sorts of options out there that if you wanted to do with that, and you just got to make sure when you are thinking about those things that that especially with retirement plans and medical insurance, that a partner is treated differently than an employee.
So yeah, making that differentiation, right?
Yeah.
And keep that in mind. And does that on the HR side, that's kind of where employee handbook and policies come into play, that people acknowledge which segment they're in, and they acknowledge the different rules that are part of that. So here we are at 12:42. There's a lot here. We're not going to talking about the detail of the consequences and compensation structures. That's obviously better for you to kind of take to Greg, for example, with from case by case scenario. So we don't need to keep point on the different scenarios here, but just kind of opening it up to the rest of the call. If there's any sort of any questions from the group, anything from anyone's experiences that they've come across where you just would like a quick yes or no question or a quick yes or no answer. So if there's anything in the group, we'll let take a couple of questions on the chat. Okay. So far, talking about taxes over a webinar is interesting on a Monday, so before Thanksgiving. So barring other questions, make that the group has your contact info, Greg, as well as mine. Real as funds are, if you're starting, if you're growing, as you're looking at compensation and how the rest of 2017 is going to play out, and 2018, now is the time, obviously, to look at this, start making elections. When do companies normally have their compensation and that structure and that piece in mind? When does that normally?
Yeah, it now, but obviously the whole world is kind of on hold until the Trump Tax Reform Act passes or doesn't pass, because things that I think every accounting firm and we were working on as well. Is just say what's the impact going to be, and we actually wrote an article talking about hedge fund and private equity and how these rules are going to impact them. But on almost a daily basis, it's been changed. So obviously when those rules sort of settle down, I think there's going to be a big scramble at your end to try to figure out how we can address all these things. But the things that definitely people should look at now that they have not looked at in the is how the new partnership audit rules are going to come into play, because all of a sudden, existing partners might have to pay taxes for prior year sins, and talking about maybe doing some sort of hold back or indemnifying people that withdraw, that sort of thing. So or maybe put down elections. These are all sorts of options that can be done right now by putting in the documents. So it's something that you'd be talking to your attorneys about things and your accountants if you haven't done so already.
So be prepared, but sit and wait and be scramble when we definitely know more before the end of the year, and just have that vision for what's happening in 2018, specifically with your firm, if you're growing, if you, whatever your map is, if you just have a bunch of partners that have worked together for the same, with the same client for a number of years, just keeping that top of mind. So, with that, I really appreciate everybody for joining. Hopefully you find some good information. If people need more info on the data that we went through on compensation, I can certainly share some of that from the side, as well as Greg, any questions that you have, Baker Tilly would be happy to answer. So, with that, I didn't see any questions on the chat. I hope everyone has a wonderful Thanksgiving and safe travels if traveling. Enjoy times with your loved ones and your families, and we look forward to seeing you next month.